Good day, and welcome back to the Life License Qualification Program video series presented by Business Career College Corporation. My name is Jason Watt, and the topic we're going to be talking about today is universal life insurance. Now, hopefully at this point, you've seen the videos concerning life insurance overview and term insurance and whole life insurance. And if you have, then you're probably ready to learn about universal life. So, universal life is a relatively new product. It was introduced in the early 1980s, and it incorporates some features of some of the insurance products we've looked at so far. It also incorporates some features of some of the investments that you will have looked at back in Module 6. So, universal life insurance is best understood by looking at its 5 characteristics. And the 5 characteristics of universal life insurance are, first off, this policy type features flexible premiums. It also features flexible coverage and flexible investments. If we wanted to summarize universal life in one word or less, the word we might choose, flexible. So this product is a flexible product. It gives a flexibility that we don't have with other sorts of products. The ability to manipulate the amount of money we're putting into the policy. The ability to manipulate the amount of death benefit that's going to be paid, and the ability to manipulate the underlying investments. Now, who is going to take advantage of all that flexibility? Well, this ball goes in the client's court. It's really up to the client, the policy owner, to take advantage of all this flexibility that we offer them. So this flexibility comes about, and then we would say it's up to the client to take advantage of it. This is a consumer accountable product. Now, that consumer accountability means that we're going to have clients here who understand a little bit about how this works. You don't have to be a professional stockbroker to manage a universal life policy, but you have to have some willingness to manage your own investments and some willingness to look at your statements every year and make sure the policy is still doing what it's supposed to be doing. If you have a client who is likely never going to do those things, then they probably shouldn't be using a universal life insurance policy. But if the client is going to regularly track their investments and is going to say, does this premium match with my expected goal, or does this death benefit match with my expected goal, on a periodic basis, then universal life insurance is probably appropriate for them. The 5th characteristic we're going to see then is that the client has the opportunity to see exactly what's happening with the policy. Universal life insurance products are transparent, or sometimes we refer to this as unbundled products. That is, you can see exactly what's happening with the policy from the client's or the policy owner's perspective. So we're first going to look at kind of a universal picture that's used to illustrate universal life insurance. And you'll see this quite a bit. The picture usually looks something like this barrel or bucket or keg, whatever you want to call it. And what happens then is our client pays premiums, or sometimes we're referred to this as deposits. Sometimes when we want to give it more of an investment characteristic, we refer to this as deposits, but whichever, they're the same thing, the money that's going into the policy. So we have these premiums or deposits going into the policy. And if we can imagine that the policy then will develop some value based on the premium or deposit going in. This value we would call, and it goes by a number of names, the account value or the accumulation fund, or the surrender value, or the cash surrender value. All of those terms are used interchangeably to refer to this. Correctly, we would say the account value is the total amount in here, while the cash surrender value is the amount that's in here less any applicable surrender charges. And universal life, like whole life insurance, tends to have fairly high surrender charges. For the first 8 to 10 years, the surrender charges tend to disappear at about the 8th or 10th year. meaning that if you want to access your cash value after that point, you could access the full value. If you want to access it earlier, you may be limited in how much you can access. So your account value then builds based on the performance of some underlying investments. And we can use a bunch of different types of investments, all things that you will have seen back in Module 6. You might have just a regular savings account here. You might use a GIC type investment or a term deposit, related ideas, both featuring guaranteed returns. You might have an index account. Index meaning that it's going to grow based on the performance of some other investment. Or you might have some mutual funds. Whichever investment we happen to choose, the client, when they exercise that consumer accountability, has the opportunity to move their money around. So you might find somebody who's initially 100% invested in Canadian equity. But then over time, maybe they move their investments around. Maybe they want some exposure to international markets. So maybe later on, they have 50% held in Canadian equity funds and 50% held in maybe European equity funds. And then, maybe a few years later, they've done well in the equity markets and they want to lock in some of their growth. So they now say, I'm going to have just 30% sitting in Canadian equity, 30% sitting in European equity, and I'll move the other 40% up into maybe a GIC or a term deposit type of investment to lock in some of my returns. It's up to the consumer how that's going to be managed. Of course, with advice from a good agent. Now, this really doesn't show any life insurance at all. We have no life insurance represented here. Any life insurance at all. We have no life insurance represented here. If we're going to represent life insurance within this picture, we're going to have to take some money out of here. And we might do something like this. We might have a couple little taps here where we're going to take some money out. And the money that has to come out, and you should remember this from Module 3 and then again from earlier in this module, that there are 3 components to the pricing of a life insurance policy. We've got the investments already taken care of here, and then we have to pay for mortality, or what we could call cost of insurance. And we're also going to have to fund the expenses of the insurance company. Now, the mortality costs will depend on some of the other characteristics here. Our mortality costs are going to depend on how we initially set up our premium structure, also are going to depend on how we've chosen to go about building the coverage for this policy. So the first thing we'll look at is the actual cost of insurance structure. With the universal life policy, there are 2 types of cost of insurance available. We can have what you might recall from earlier in this module would be referred to as a YRT, or a yearly renewable term cost of insurance. And with that yearly renewable term cost of insurance, in the early days, your insurance cost can be relatively cheap, but as you get older, it's going to get more and more expensive. Or, you might also remember, we could have a level, or sometimes we'd refer to this as T to 100, cost of insurance. It depends what we're looking for. Normally, a client who's younger and investment focused might choose a YRT premium structure initially. And that YRT premium structure will keep their costs down, allowing them to put more money into the policy. That is, more money would stay with the account value. If we have somebody who's maybe a little bit older or less investment focused, they might use a level cost of insurance. And with the level cost of insurance, they know that they're not going to see that increase in their cost of insurance later on in life. Some insurers, in fact this is quite common today, will allow you to initially purchase a YRT structure and then at a predetermined point switch that YRT over to a level structure. This is almost like the best of both worlds. You have that low cost initially and then you're going to switch to a level structure later on, so you'll never see your prices increase to a point where they become unmanageable. But keep in mind that at the point where you make that switch to a level premium structure, the cost of insurance at that point is going to be based on your age when you make the switch, not on your age when you originally acquired the policy. So it's not cheap to do that. Now, within the policy, there are 4 different death benefit options that we can choose. We're going to talk about that again in a minute. The thing to remember here is that when we're taking money out to pay for mortality, we have to take into account the cost of insurance that we've chosen. We also have to take into account which of the 4 coverage options we have chosen. Whatever doesn't come out to pay for mortality or the expenses of the insurance company, which we also call the policy factor or policy fee, you will recall that from Module 3. Whatever doesn't come out to pay for mortality or expenses is going to stay in the account value and go into whatever type of investment our policy owner has chosen, and we'll start building up that value now. Okay, before we go on to the 4 different death benefit options, I will take a moment to talk about this transparent or unbundled characteristic of this policy. And it's useful for understanding this transparency to compare this to a whole life policy. You might recall from the whole life policy, within the whole life policy structure, we have premiums being paid, and we knew exactly what those premiums were going to be. There was no doubt what the premiums were going to be. And we had a death benefit that was also known. Of course, with a non-par policy. With a par policy, we saw there was some opportunity for some flexibility here, but you know with any whole life policy, it's always going to be at least what the promised amount is. So we had a death benefit as well that was promised at the point at which death occurs. And we also had a cash surrender value, and you'll recall that that cash surrender value was also a known amount. As the policy owner, you didn't have to do anything to take advantage of this situation except pay your premiums. And what happens here in the interim is really not something you have any exposure to. This is all done by the actuaries who work at the insurance company. Their job really is to make sure that your promises get met as long as you continue to pay your premiums. So a whole life insurance policy, very simple. There's nothing to worry about as far as managing the policy later on. Whereas in a universal life insurance policy, you really do have to manage this policy. So if we can look at the same characteristics here, we have flexible premiums. We don't know what they're going to be. We have flexible coverage. We don't know exactly what the death benefit's going to be. And we have flexible investments. We don't know exactly how much is going to be in the policy. So you pay your premiums, you're not sure what your death benefit's going to be, you're not sure what your account value is going to be, but while you own the policy, you will have complete visibility as to what's happening with your policy, and it's really up to you to make that work for yourself. So we can see the difference between the policy owner's responsibility with a whole life policy and the policy owner's responsibility with a universal life policy. The person who acquires a universal life policy and doesn't pay attention to it, if they get lucky, it might work out for them, but they're not paying attention. This thing could all not work out the way it was expected to. If we're counting on somebody taking care of their policy, then this is where we're going to go. If we have a client who's going to take a hands-off approach, this is probably the better approach, the whole life policy.